I want to start with a distinction that I think is more important than almost anything else I could offer you in this video. The distinction is between an economy that produces things and an economy that produces claims on things. A producing economy is built on the actual creation of value, on manufacturing, on infrastructure, on the physical and human capital that generates goods and services that the rest of the world genuinely wants to acquire. It is an economy whose strength is grounded in reality, in things you can touch, use, ship, and sell. A claims economy, what I'm calling a paper economy, is built on something different. It is built on the financial instruments that represent claims on productive capacity, stocks, bonds, derivatives, structured products, and the extraordinary architecture of financial innovation that has been constructed on top of them over the past several decades. Its strength is not grounded in immediate productive reality, but in confidence, in the collective belief that the claims are good, that the underlying assets are sound, that the institutional architecture maintaining the whole system is trustworthy. A claims economy can work extraordinarily well for a very long time. The financial architecture of the United States over the past 40 years is, in many respects, one of the most impressive wealth-generating mechanisms in human history. The returns it has delivered to those positioned to benefit from it have been genuinely extraordinary. But a claims economy has a structural vulnerability that a producing economy does not. When the confidence that sustains it is tested, when enough serious actors begin to question whether the claims are actually as good as advertised, the architecture that was built on that confidence can deteriorate much faster than anyone who built their financial life around it would expect. I believe that stress test is happening right now, not in a simple or linear way, not in a way that produces a clean, obvious signal visible to everyone at the same moment, but in the specific, observable, measurable ways that I've learned to recognize through decades of studying exactly this kind of transition as the early stages of something structural. Let me show you what I'm seeing. To understand why I think America's paper economy is breaking, it helps to understand how it was built. Not in a critical way. The choices that produced it were rational at every stage, given the incentives and information available at the time, but in a structural way that reveals the vulnerabilities that are now becoming visible. Over the past 4 decades, the United States made a set of economic choices that, taken together, represented a fundamental bet on the durability of American financial primacy. The bet went roughly like this: because the US dollar is the world's reserve currency, and because the world's demand for dollars creates a permanent market for dollar-denominated financial assets, the United States can run persistent trade deficits, importing more than it exports, without the currency crisis that would afflict any other country in the same position. The dollars that leave the country through trade come back as investment in American financial assets. The recycling of trade deficits into financial investment creates a self-sustaining demand for American stocks, bonds, and financial instruments. This recycling mechanism is, in its essentials, the petrodollar system, the arrangement by which global energy trade is settled in dollars, creating a permanent global demand for the currency that funds American borrowing. And it is the foundation of what I mean by the paper economy, an economic model whose core comparative advantage is not producing things, but producing the financial claims that the rest of the world needs to conduct its business. This model produced remarkable results for a long time. American financial markets outperformed almost every other category of asset for decades. The wealth generated within the financial sector, and among those positioned to benefit from rising financial asset prices, was genuinely transformative. The American paper economy became, at its peak, the most powerful wealth-generating machine the world had seen. But it had a cost that was not immediately visible. The same model that directed capital toward financial asset production directed capital away from physical production. Manufacturing declined, infrastructure aged. The supply chains, the skilled labor forces, the industrial capacity that had made America the world's dominant producer were allowed to atrophy, because in the logic of the paper economy, it was more efficient to buy from whoever produced most cheaply and invest the savings in financial assets. This was not stupid. Given the incentives that existed, it was rational. but it created a structural dependency on imports, on global supply chains, on the continued willingness of the rest of the world to accept dollars in exchange for real goods that is now becoming visible as a vulnerability rather than a strength. Let me describe the specific fault lines that I think are now cracking in the paper economy architecture. Not as a comprehensive inventory of everything that could go wrong. That list would be too long and too speculative to be useful, but as the four specific structural pressures that I think are most consequential and most clearly observable. The first fault line is the debt trajectory. The United States government's fiscal position, the gap between what it spends and what it collects, has reached a level where the mathematics of debt sustainability are genuinely concerning. Not because any specific debt level is magically problematic, but because the trajectory matters as much as the level. When debt grows faster than the economy, and when the interest cost of that debt is itself growing as a share of the budget, the feedback dynamics become self-reinforcing in ways that are difficult to reverse without significant disruption. What makes this particularly challenging in the current environment is the interaction between the debt trajectory and interest rates. For most of the period during which the debt accumulated, interest rates were extraordinarily low, which meant the cost of carrying the debt was manageable, even as the debt itself grew. That condition no longer holds. The combination of a larger debt stock and higher interest rates creates a fiscal pressure that has no comfortable resolution within the existing framework. The second fault line is the industrial hollowing. The paper economy's comparative advantage, producing financial claims rather than physical goods, came with a cost that is now becoming strategically significant. The United States is substantially dependent on imports for many of the physical inputs that a modern industrial economy and a modern military requires. That dependency, which seemed like an efficient use of comparative advantage during periods of geopolitical stability, looks very different in an environment of genuine geopolitical competition. The recognition of this dependency is driving significant policy effort to reverse it. But reversing 40 years of industrial offshoring is not a short-term project. The supply chains, the workforce, the physical capital, and the institutional knowledge required to rebuild genuine industrial capacity take years and sometimes decades to develop. The gap between the urgency of the strategic need and the timeline of the solution is itself a source of vulnerability. The third fault line is the dollar's strategic position. The dollar's reserve currency status, which is the foundation of the paper economy's model, is under more serious challenge than at any point in recent memory, not because any alternative is ready to replace it. No alternative currently has the depth, the liquidity, or the institutional infrastructure to serve as a genuine reserve currency at the dollar's scale. But reserve currency status does not require a replacement to be undermined. It requires only that enough actors in the global system begin to make incremental decisions, to settle some trade in alternative currencies, to accumulate some reserves outside dollar-denominated assets, to build some payment infrastructure that routes around dollar-based systems. To gradually erode the structural demand that sustains the paper economy's recycling mechanism. That incremental erosion is observable in actual data. It is slow. It is contested. It is far from complete. But the direction of travel is measurable, and the direction matters as much as the current level. The fourth fault line is the confidence gap. Perhaps the most subtle but ultimately most consequential fault line is the growing gap between the confidence that the paper economy's current valuations require and the confidence that the underlying fundamentals support. The valuations embedded in American financial assets, in stocks, in real estate, in the complex architecture of financial instruments built on top of them, reflect a significant degree of confidence that the conditions of the past decade will persist. That monetary accommodation will continue, that dollar dominance will endure, that the recycling mechanism that has sustained demand for American financial assets will keep working. When that confidence is tested, when serious actors begin to question whether the conditions will persist, the adjustment in valuations can be rapid and significant. Not because the underlying businesses become less valuable, But because the premium for confidence, once lost, can take a very long time to rebuild, I want to put the current moment in historical context because I think the context is genuinely illuminating rather than merely interesting. Economic model transitions, the moments when a dominant economic arrangement proves insufficient and the actors within the system are forced to find a different model, are not unprecedented. They are, in fact, recurring features of economic history, and they share certain structural characteristics that I think are directly relevant to understanding what is happening now. The first characteristic is that they are almost always resisted long past the point where the evidence of their necessity is clear. The actors who benefit from the existing model, and there are always powerful actors who benefit substantially from any model that has been dominant for decades, use their influence to slow, modify, and minimize the change rather than to accelerate it. This resistance is not irrational. It reflects genuine interests, but it tends to extend the period of instability by preventing the clean, rapid adaptation that would minimize total disruption. The second characteristic is that the transition, when it finally occurs, tends to be more comprehensive than anyone expected. The comfortable version of economic model transitions is that you change the parts that aren't working while preserving the parts that are. The historical reality is that the parts are more interconnected than they appear, and that changing the fundamental model requires changing more of the structure than the comfortable version anticipated. The third characteristic is that the transition period, the years or sometimes decades between the failure of the old model and the establishment of a genuinely functional new one, is characterized by volatility, uncertainty, and the kind of policy experimentation that produces both surprising successes and significant failures. We are, I believe, in the early stages of one of these transition periods. The paper economy model, the model that has been dominant for 40 years, is showing the specific structural strains that historically precede model transitions. The actors who benefit from it are resisting the change. The policy responses being attempted are more tentative and incremental than the scale of the challenge probably requires. And the volatility that characterizes transition periods is very much present. I want to spend time on a specific dynamic that I think is particularly important for understanding the current policy environment, and that I think most mainstream financial commentary consistently underweights. There is a fundamental tension between what I'll call sovereign interests and financial interests in the current moment. And that tension is not simply a political disagreement about policy preferences. It is a structural conflict between two different conceptions of what the economy is for and who it is supposed to serve. Sovereign interests, the interests of the nation as a whole, understood in terms of its productive capacity, its strategic independence, its long-term competitive position, point toward rebuilding industrial capacity, reducing dependency on imports, and reorienting the economy toward physical production rather than financial claim production. These interests require some degree of dollar weakening, some degree of trade restriction, and some degree of priority shift away from the financial sector that has been the primary beneficiary of the paper economy model. Financial interests, the interests of the institutions, investors, and individuals whose wealth is concentrated in financial assets, point in exactly the opposite direction. They benefit from dollar strength, which maintains the purchasing power of dollar-denominated assets. They benefit from open trade, which keeps costs low and maintains the global supply chains that the paper economy model depends on. And they benefit from the continued recycling of global trade surpluses into American financial assets, which sustains demand for the claims they hold. These interests are not simply in political disagreement. They are structurally opposed on several key dimensions. And the policy environment we are currently living through, the volatility in trade policy, the tension between branches of government over economic authority, the apparent contradictions in the signals being sent about the direction of American economic strategy, reflects that structural opposition being worked out in real time. What is significant about this tension for investors and for anyone trying to navigate the current environment is this: neither side of this tension is going to win cleanly. The sovereign impulse toward reindustrialization is real and is backed by genuine strategic necessity. But the financial industrial complex's capacity to resist and redirect that impulse, through legislative action, through judicial action, through the sheer weight of its economic influence, is also real and substantial. The result is likely to be not a clean transition from one model to the other, but an extended period of contested, volatile, partially implemented change, during which the uncertainty itself becomes a significant economic force. And uncertainty, as I've learned through long experience, tends to be resolved in the price of assets long before it is resolved in the policy environment. I want to be precise about what I mean by breaking, because I think the term can be misread in ways that lead to either overreaction or dismissal. When I say the paper economy is breaking, I don't mean that the financial system is about to collapse. I don't mean that American institutions are on the verge of failure. I don't mean that the dramatic sudden end scenario that conspiracy-minded commentators sometimes describe is imminent. What I mean is something more specific and in many ways more consequential for ordinary investors and households. I mean that the model, the specific economic arrangement that has driven the extraordinary performance of American financial assets for the past 4 decades, is reaching the limits of its capacity to produce the outcomes it has been producing. That the conditions that made it work are changing in ways that the model cannot fully absorb without significant structural adaptation, and that the process of that adaptation is already underway, even if it is not yet fully visible in the headline financial indicators. This has specific implications. The first implication is that the returns that American financial assets have delivered over the past decade are unlikely to be replicated over the next decade in the same way, from the same sources, under the same conditions. This is not a prediction that markets will crash. It is a more measured observation that the structural tailwinds that powered the past decade's performance are becoming headwinds, and that expecting similar performance under different structural conditions is a form of extrapolation that history consistently penalizes. The second implication is that the distribution of returns across asset classes over the next decade is likely to look meaningfully different from the past decade's distribution. Assets that benefited most from the paper economy's dynamics, financial assets in general, and particularly those most sensitive to the monetary conditions of the past decade, face a more challenging environment. Assets that are most independent of those dynamics, or that benefit from the specific transitions underway, face a more favorable environment. The third implication is that the volatility of the transition period itself, the uncertainty generated by the structural conflict between sovereign and financial interests, by the contested nature of the policy choices, by the gaps between where the economy needs to go and where the existing institutional arrangements want it to stay, is likely to persist for longer than most market participants are currently pricing. Let me close with the practical framework I use when thinking about how to navigate a period like the one I've been describing. The core principle is this: in transition periods, the primary risk is not volatility. The primary risk is being wrong about which model you're transitioning from and which model you're transitioning to. Volatility is manageable if your framework is right and your positioning is resilient. Being wrong about the direction of the transition, being heavily positioned for the continuation of the model that is breaking, produces a very different and much more difficult outcome. So the most important question is not how do I reduce volatility? It is, am I positioned for the model that is coming or the model that is going? The model that is going is the paper economy model, the model in which the primary source of real returns was financial asset appreciation driven by dollar recycling, accommodative monetary policy, and sustained global confidence in American financial primacy. The model that is coming is not yet fully defined. It never is in the middle of a transition, but its broad contours are visible in the structural forces at work. It is a model in which physical productive capacity matters more than financial claim production, in which assets that are independent of any particular monetary arrangement preserve value better than assets that depend on one, in which the global balance of economic power is more multipolar and less unipolar than the model being left behind. Positioning for the model that is coming means several things practically. It means increasing exposure to assets whose value is grounded in physical reality and finite supply rather than institutional confidence. It means reducing concentration in the specific financial assets that have been the primary beneficiaries of the paper economy's dynamics. It means maintaining enough liquidity to navigate the volatility of the transition period without being forced to sell at exactly the wrong moment. And it means doing all of this with the intellectual humility to recognize that the timeline and the specific path of the transition are genuinely uncertain, and building a positioning strategy that is resilient across a range of scenarios rather than optimized for a single predicted outcome. This is not a call to panic. It is a call to update, to look honestly at the structural evidence, to ask whether the investment framework you've been operating with is calibrated for the model that existed or the model that is emerging, and to make the deliberate, thoughtful adjustments that the evidence suggests are warranted. Before my closing thoughts, 3 brief things. First, I've put together a framework document that walks through how I evaluate asset positioning during economic model transitions, the specific questions I ask, the structural indicators I monitor, and the principles I use to build positioning that is resilient through the volatility of transition periods. It's in the description and completely free. Second, if you want to go deeper on the macro and structural forces driving the current transition, in a community of serious long-horizon thinkers who are committed to understanding these dynamics with clear eyes, I've built exactly that space. Details are in the description. And third, if this kind of clear, honest, framework-driven analysis is useful to you, subscribe. The transition I've described is going to keep developing. I intend to keep tracking it honestly. Let me close with the most important thing I can say about this moment. The title of this video is America's Paper Economy is Breaking. That is not a prediction of collapse. It is an observation about structure, about the specific ways in which a model that has been extraordinarily successful for 4 decades is reaching the limits of its capacity to continue delivering the outcomes it has delivered. About the structural forces, the debt dynamics, the industrial hollowing, the dollar's contested position, the confidence gap, that are applying pressure to an architecture that was built for a different set of conditions. The investors who will navigate the next decade most effectively are not the ones who saw this most precisely or predicted the timeline most accurately. They are the ones who recognized early enough that the model was changing and who made deliberate, principled adjustments to their positioning before the change was obvious to everyone, while the adjustment was still something they could make from a position of choice rather than necessity. The paper economy is breaking, not all at once, not in a way that produces a single, unmistakable moment of rupture, but in the slow, structural, measurable way that genuine economic model transitions always break, quietly, then suddenly, for anyone paying close enough attention. Pay attention. I'll see you in the next one.